I'm Cindi Bough. I'm Managing Director at Climate Investment. Fantastic event. What a great group of folks, right? We have investors, entrepreneurs, academia, thought leaders, all in a room, having a great discussion talking about how we can decarbonize our planet. Why does it matter? We're here for the future of our children and our grandchildren, and there may not be a good future if the planet continues to heat. So it's extremely important to me as a mission and what I do every day and why I am a climate investor. Hard problems are, steel industry, concrete industry. These are hard industries that have a significant amount of greenhouse gas emissions. It is a big part of who we are in terms of how we build things, how we manufacture things, how we live. And it's everywhere. And it's really hard to rebuild those processes so that they're greener. They take an immense amount of energy, electricity to heat and to create these materials, and to decarbonize these industries will take time. Actually, I loved the panel on built environment because I sat there with one of our entrepreneurs, the CEO of Converge, and Raf started talking to me about bioconcrete and growing buildings, which is not necessarily an investment opportunity today, but there are a lot of academic research labs that are focused on it. So I would love to go and find out, speaking to Purdue, speaking to Stanford, speaking to MIT, to learn more about what they're doing on the bioconcrete side. Well, actually, we just made an investment in a bus electrification company. And if you look at the TCO of a diesel engine bus versus an electric one, with the Biden administration 20 billion grants and stacking grants, we can actually get the upfront CapEx cost to be lower than a diesel bus. On top of that, the ongoing operations and maintenance of an electric vehicle versus a diesel vehicle is significantly less. So that's where you're seeing, this is the future. All school buses will be electric. Maybe not today, and maybe not in the next 10 years, but this is an inevitable, where we see electrification of heavy-duty vehicles transporting the most important precious goods ever, going to be such an important part of our future, and where the green premium doesn't exist, and it's actually really exciting to get there. I think building electrification is inevitable. And the reason I think that is renewable energy today is already at parity or below for fossils. Paired with storage makes it not intermittent. And if you can have renewable energy at 2 to 3 cents a kilowatt hour, and you can power the planet, you would hope that the electric grids around the world are green. And then thus, the electrification of transport, the electrification of buildings, those are really where I see and hope there's an inevitability. Granularity of green is interesting as you talk about the grid, because the grid is the biggest battery that we have today. It stores electrons and manages and moves them around to where the demand and supply needs are. And when you're moving to distributed resources, distributed demand, so you're talking about vehicle electrifications and distributed heat, heat pumps on the individual level, and then you're talking about distributed generation, the market is a little bit dislocated, and you think about, well, these are some nuances that you really have to understand around the flexibility of the grid, understanding how do we avoid putting an additional piece of transmission and another substation out there, which is very, huge amounts of CapEx. And can you use distributed energies to then green the planet in a better way? It's a great question, and I think collaboration is the key. One, venture capitalists collaborate with each other, and we syndicate and we invest together to disrupt and bring innovation into the world. Second of all, it's key for us to be collaborating with the public side. On the government side, not just for grants and just for mandates and the policy side, but going hand in hand and saying, where is the largest opportunities and how can we work together to educate, to partner together. One of my portfolio companies was at the White House yesterday, meeting Biden, front page, at the White House demo day, right? And so one of the things that we're talking about is not just getting Loan Program Office grants, DOE grants, but also the state of Michigan grants, and putting those all together and saying that's going to be the catalytic capital paired with the venture capital that's going to bring this innovation forward. And I think that's really key, right? So I don't actually see competition. That's by far something that we need to collaborate more. So I am a big fan of TDK Ventures and the team at TDK Ventures. We've looked at many opportunities and investment opportunities together. The level of depth and breadth in terms of the diligence is very comparable to what we look at. On top of that, I've been a panelist at Energy Week, loved the opportunity. I actually learned a lot from my panelists that I was on the panel with. And I thought it would be an amazing opportunity to elevate both brands in terms of sharing what we know with the broader ecosystem. Elevating brand doesn't mean like we are better out there. It means that we are able to collaborate with others, that they know that we are part of the ecosystem, especially on both sides of the pond. So I'm an American. I grew up in Silicon Valley and been an investor in San Francisco. Obviously, TDK Ventures has an arm, a big presence in Silicon Valley, and TDK Ventures wanting to move to London and myself actually relocating to London with my family this summer was really a great serendipity. And so when Tina reached out and Kareem reached out and said, hey, what do you think? We're looking for a co-host to do our first in-person hybrid virtual event. I said, this could actually be really fun. This could be really great. We bring in investors that we all like to collaborate and syndicate with. We can bring in thought leaders that are going to help educate the ecosystem. We can think through what are the potential new startups that are working on cool technologies that we can maybe co-invest with. I mean, TDK Ventures is the perfect partner for climate investment. Secret sauce of Energy Week is the people, and it's the entrepreneurs. The entrepreneurs bring so much energy. It's the reason we exist as investors. We support them with capital, with network, and with whatever they need. You know, if they need a shoulder to cry on, we're there also, right? But the crux of our world and the crux of an investor is to support an entrepreneur in their journey and to help that innovation and help that technology and help that company really flourish to scale and to deliver real impact. Climate Investment is a specialist decarbonization investor. We have about $1.5 billion under management. We invest on the venture and growth equity stage, and we look at two key things when we look at startup companies. One, we look at greenhouse gas impact. So how is the company reducing the impact? Not the potential of what they could do in a greater TAM view, but what are they doing and what is their plan to do that? And that's a key criteria of ours. Second criteria is clearly financial return. We want companies to flourish and to scale and to deliver impact. To deliver impact, it's inextricably tied to economic performance and good financial outcome. Some people say impact is like a gift. Impact investing is a little bit like charity work, and we don't agree with that, right? Impact investing is really like we have impact first. We look at that as a filter and a lens, but we still invest in the best teams with the best technologies, with a massive market potential, with opportunities to scale, and we're there as an active investor along the way to help them. Well, it is an interesting time. We've just gone through sort of some depressions from the highs of 2021, 22. We are coming off the SPAC bubble and there is no IPO market. I think the amount of IP that's being filed and the innovation is still vast. I think the valuations that you can enter in are actually more reasonable. I think the challenge that we still see is interest rates. So if a company needs to access venture debt, the interest rates plus plus a few bips is still really high. And I think that will continue to impact commodity costs and structural costs for all across sort of the cost and the BOM as they deliver, right? So it depends. I think there's goods and bads with where we are in the ecosystem today. There are always amazing entrepreneurs innovating. So finding those nuggets where they can withstand sort of where we are in the interest rates, I think will be really important. Financial type returns for venture in clean tech versus, let's call it just tech in general, are not equivalent. I would say living through Clean Tech 1.0, you would see about 80 to 90% of the startups and the capital behind it not returning. So clean tech is hard. Clean tech takes time. It takes a lot of capital cycles. And so what's different now in this new wave? There are definitely more types of capital along the stack. There is a significant change in terms of the corporate rhetoric and the corporate requirement to hit net zero, to mandates, or the mandates on the policy side are much stronger. Carbon taxes are out there, carbon tariffs are out there. So the market ecosystem is stronger, and the different types of capital, there is now not just venture capital. There's venture capital, there's first of a kind capital, there's project equity capital, and there's different stacks of capital. And the public markets are playing a lot more. And you're seeing sort of the PE folks coming in and playing on that later stage capital, which is really great. I still see sort of that middle being a little bit of a challenge, and that's where we like to play. Like, we like to get in on the innovation, and we like to withstand with our companies through that ecosystem, through that first of a kind, through that next commercial scale plant. And then you can find in private equity money, you can find infrastructure money. There is a lot of capital behind that. And so getting to the return side, it's going to have to be a little bit like Clean Tech 1.0. We're not talking necessarily 10x returns. We'd love to get 10x returns. But I think that level of expectation on doing a portfolio where most of your portfolio doesn't return and you have one big return, 10, 20, 100xer, is not how clean tech works. It's not how climate works. We want to see most of our companies succeed. We expect most of them to exit probably through M&A. And the M&A multiples, like the incumbents and the large players who are acquiring, don't typically pay that exorbitant amounts. They could pay a good amount. They often bake in synergies. So let's aim for 5 to 10x, right? For more of our portfolio companies. But I think it requires a venture investor to not just invest at the first round. You will get diluted. So I think venture investors who are coming in, hoping to hit some great returns, invest in technologies, and then continue to invest through their cycles until they can get project equity and private equity. It's really hard as a CEO. I was a CEO founder of a vehicle electrification startup in 2006. A little bit of timing, market dislocation there. And it's really hard to juggle, right? You're trying to build a technology, validate a technology, figure out if there's commercial traction, figure out your unit economics, and on top of that, you're out there fundraising all day long. So if you talk to a typical startup CEO, they spend 80 to 90% of their time when they're in fundraising mode, fundraising. They're talking to investors, building the data room, figuring out, responding to the questions, and they're not building the business, right? And so we understand that it's not going to be a one and done, and it's important for us to have reserves along the stack of capital formation if the company is performing and hitting milestones, right? And I think that level of comfort is important not just for the entrepreneur, but also for the future amount of capital coming in, right? So the future investors in the B round and the C round, et cetera, they want to see that their existing investors are supporting the company, and they have made milestones from X, from A to B, and then they've passed through their investment committee for a follow-on round. I think those are really critical, and that's one of our sort of strong suits, because we have a large fund to be able to do that. Empathy is critical, right? In venture, we take high risk for high return. Maybe it's moderated return compared to tech, but we take high risk for high return. And that means there's going to be pivots, there'll be bumps along the way. Oh, we thought that we were getting this new incentive and all of a sudden it doesn't work. We were Energy Star rated and then Energy Star moved their boundaries and no longer are we Energy Star rated. I mean, things happen. Oh no, like something happened to one of the management teams. That's very common. Like there's management team disruption, due to personal conflict. Someone's got a health issue or someone's family has a health issue. I mean, there's all these things that can happen. And I think that you sometimes can see some investors being really hard and saying, well, if you fail and don't hit my milestone, I'm gone. And it's hard. The road to entrepreneurship is very difficult. I've been there, and I think being able to be in those shoes and saying, I know how hard it is, and I know that you won't hit plan exactly to plan, and it may be actually better in some ways and worse in some ways. And like we're here to help support you and guide you. And I often say this, where as an investor, we're on the bus, and the entrepreneur is driving the bus. We can only say, hey, I think there's an exit coming up. You might want to take that turn, or, oh, I think looks like there's bad traffic over there, so maybe you don't want to go there, right? So we're there to support, we're there to guide, but we're not driving the bus. Like really, we put our eggs in the entrepreneur basket, right? Like we are believing in the team. And so that's often one of the things you really have to have an insight into how coachable is that entrepreneur and how pliable are they in terms of trying to hit the, oh, something's happened and can they be resilient and move? And then also like how North Star are they? Like, will they go through bumps and will they still be pushing forward to their North Star? Those are really, qualities that we look for from an entrepreneur. And I think being an entrepreneur myself, those are things I look for. And those are things that I remember, like the journey's hard. And so empathy's key. That's the ugly side of venture capital that's not often talked about. And it comes in the form of we have two sides to our customers. Like we talk about our entrepreneurs as customers, but we as a firm also don't exist if we don't have funding from our limited partners. So we take money from our limited partners in order to deliver them value. And they define what that value is, whether it's strategic value or financial value, and it's usually a combination of two. And if we're not able to deliver that financial impact, and we struggle because the company is struggling, sometimes tough love is necessary, right? Because we need to also be there and existing as a future investor in a future fund, right? So I think there needs to be sort of a balance of who our customers are, and that's where sometimes you see a venture capitalist being a little bit tough. One of the things that we do is when things aren't going right, we try our best to support and fix it. If a CEO might need an advisor, they may need a coach, they may need a change in terms of the structure, they may need some help in terms of thinking through how to scale, they need connections into folks. So we do that, and we are trying to be as helpful and cheerful as possible. But I do think, when it comes down to you didn't hit plan and tell us why, that's okay, but we still need to hit our metrics. You have to understand that us going to investment committee is really hard, especially when you're not hitting plan. So, I think entrepreneurs also need to understand that, like, we have bosses too. I'm optimistic that there are so many people changing their careers and wanting to dedicate it to climate. People who have been successful entrepreneurs and successful company builders, as well as the new grads coming out of the universities and schools. Climate is a big problem, and I think it's now known. Schools are teaching it to children that like oceans are full of plastic, and like we've done that. We as humans have done that. And so I think there's no longer that required rhetoric to say, hey, climate change exists and there's a problem, and really trying to fight that problem, fight the story, right? It's true, we know it's true, and there's a lot of people trying to fight it, right? And there's a lot of people on board. And I think you need that level of, the folks on the legal side, folks on policy, people in marketing, people on the consumer who understand how to scale large oil and gas plans. Like, we need people across all sorts of disciplines to be involved in this fight. And so that gives me a very strong optimism that there are lots of people wanting this to happen. Our fund is globally focused, and we see that there is great opportunity, and we invest today primarily in North America and Europe. And the reason is a lot of the innovation is coming out of that. In Europe, very specifically, there is more IP filed in Europe than in the US. So I think the technology development is very strong. The ecosystem on technology development is very strong. And as we talked a lot about at Energy Week, mandates in Europe are more common than incentives. So mandates, but also public monies. And those two combined are actually really quite interesting. There are big, bold targets, and there are carbon tariffs and penalties, as well as a lot of public monies for companies. So I think that's going to be a really nice opportunity for certain areas to develop. That being said, Europe's ahead on certain things, Europe's behind on certain things. So a little bit of an example. Heat pump deployment, electrification of EVs. Look at the Nordics. The EV adoption is in the 80s and 90%. The heat pump adoption's in the millions here. It's just starting to be a term in the US, right? That being said, smart meters are not widely deployed in Europe and very disparately across each country. And that's a big challenge, right? If you're talking about smart home and wanting to manage distributed energy resources and having a smart thermostat, it's still really hard to adopt that because smart meters don't even exist here, right? So, versus the deployment in the US of smart meters is in the 20 millions, right? So it's interesting because each ecosystem has their pros and cons. The other thing I was going to say about Europe that is challenging for entrepreneurs is that it's a group of many different group of many different countries with different cultures and different languages and different ways they think about recycling, ways they think about energy, way they think about distributing the grid. How green is their grid, right? So each country has a unique profile, and so it's a little bit more complicated to scale within Europe. I think the opportunity is the European founders are different. And I think I come from an American background with a US investment, typically investing in US companies. And so I understand US companies and entrepreneurs love to talk about the vision. And they raise a lot of money and they have big valuation, and you double or triple every time you raise, and you go big. Go big or go home, right? Michael Liebrich was talking a little bit about that, and that's really true. I think the European ecosystem and German entrepreneurs are my favorite. They have a plan and they stick to the plan and they deliver to the plan, and they raise and they deliver and they raise and they deliver, and it's very execution and it's very linear, and you don't see this sort of hockey stick growth, but then they actually are very disciplined about the capital deployment. So the question is who wins, right? So very often you see exits in Europe being a large US company with a lot of funds who wants to come to Europe and access that, finds a European company and buys them. So an example is GetAround. GetAround is a ride-sharing company in the US based out of San Francisco. They raised a lot of money. They had about 1,000 vehicles in their fleet. And there was a company here called Drivey. Drivey was based in France. They had a lot more, I think in the 10,000 number of vehicles on their fleet all across, but their utilization wasn't as high. Instead of GetAround coming to Europe and trying to grow, they decided to buy Drivey and then take their application of the high utilization model and apply it to the large fleet, which I think was a really clever way of thinking about it. So it's good for us from an investor perspective because we see like a natural exit for that, US, European kind of difference in entrepreneurs and raising. Heat pumps matter significantly. One, I think you can have heat pumps being fully electric, so you can be displacing not just natural gas, but sometimes heating oils. And that's a significant emissions associated with just a need that everyone has. Heating and cooling as a combination is about, so in the US, the statistics are 50% of the US homes are heating and cooling, and 30% of buildings. If you look at it globally, it's about 40% across the board. And so that's a huge amount. You're talking about buildings and the built environment and the footprint being heating and cooling, and a solution is a heat pump, which is, if electrified and the grid is electric, has a huge opportunity to displace a lot of greenhouse gas emissions. So I think that is one of the first opportunities out there. And also we talk about like electrified heat and having that as an industrial application. That's on the industrial scale. So first I was talking sort of more on the building and residential side. Industrial heat pumps are also a huge opportunity. Typically now up to 200 C, very efficient, also displacing natural gas and oil. So I think that's why industrial heating through, sort of the low temperatures for heat pumps is a great opportunity. If we're talking about medium temperatures, the refineries and aluminum, those tend to also, so we're talking kind of from 200 to 1200 C, that's going to require a different solution. And there are a couple of interesting startups working on that sector. And it's a really big piece of the market that could be decarbonized. And then the last piece of sort of the industrial heat equation is on that really high temperature. So we're talking about steel and concrete, and those are really high temperature processes, and that's going to require quite bespoke solutions. And so, I have a huge passion for industrial heat and want to find like investment opportunities that really deliver reduction in greenhouse gases. I am ecstatic and definitely looking forward to Energy Week 2024. Maybe we can make there 2 weeks in 2024.